All right, so today we're going to take a deep dive into Canadian National Railway's third quarter financials for 2024, and especially going to be looking at things through an investor's lens.
Yeah.
We've got a pretty good stack of documents here. We've got the presentation slides that CN released. We've got their full financial statements, of course, and then we've also got their quarterly review, which is always a good read.
Yeah, you always get some interesting color in that quarterly review.
Definitely. So jumping right in, CEO Tracy Robinson starts things off with a very confident message. She says that the railroad is running very well. Now, is this just the typical corporate optimism you see in these reports, or do the numbers actually back it up?
Well, I think there's some promising signs in the data. For example, revenue ton miles, which is kind of the gold standard for how much freight they're actually moving. That's up 2% this quarter.
Okay, that sounds good, 2%. But we're also in a time of pretty high inflation right now.
Right, exactly. And there's a lot of people talking about, a potential recession on the horizon. So I think investors really need to look at that 2% growth and ask themselves, is this sustainable?
Yeah, that makes sense. I mean, it's one thing to have growth, but it has to be good growth.
Yeah.
It has to be sustainable growth, right? Now, Robinson also highlighted CN's various growth initiatives, and she really emphasized them as a key driver for the good results that they're seeing, even in what they call a weaker than expected macro environment. So I'm curious, what are your thoughts on these initiatives?
Well, it seems like they're very focused on operational efficiency and really trying to wring every bit of productivity that they can out of their existing network. They're talking a lot about improving their operating margins, which is obviously a key metric for any investor who's looking at a company like CN.
Definitely makes sense. Now let's get into something that I think is always a bit of a yellow flag. At least it makes me raise my eyebrows a bit. And that is the fact that CN is using these adjusted performance measures, non-GAAP stuff. I always wonder what that, are they just trying to, hide some of the bad news
Yeah.
or massage the numbers to look a little bit better than they actually are?
Yeah, I mean, you always have to be careful with that. But in this case, I actually think the adjustments they're making seem pretty reasonable.
Okay, good.
For example, they adjusted for a $78 million loss that came from selling the Quebec Bridge.
Oh, yeah, I saw that. So on the surface, that sounds like a bad thing.
Right, sounds like a loss.
Yeah.
But they actually sold this bridge to the government, and it was some aging infrastructure, so they were able to offload those costs.
Oh, okay. That makes
And
sense.
so it's actually, potentially a good move in the long run, even though it creates a short-term hit to the numbers.
So it's kind of like, they're taking a little bit of pain now, but it could set them up for better performance down the road.
Exactly. It's all about, understanding the strategy behind these adjustments.
Definitely. So let's talk earnings. Diluted earnings per share are up 2%.
2%, yeah.
Is that a good thing for investors?
I mean, it's an increase, but I think the more important question is, how does it compare? How does it compare to how they've done in the past? And how does it compare to other companies in the industry?
Okay, so it's all about context.
Yeah, you got to put that 2% into context to really understand if it's a win or not.
Makes sense. Now let's talk about free cash flow, because this is a big one for investors. And it's actually down 9%.
Yeah, that's a pretty significant drop.
Yeah, it is. What do you think is driving that?
Well, it could be a few things. One possibility is that they're investing heavily in their capital program, which we'll talk about more later.
Yeah, they're spending a lot of money.
Yeah, $3.5 billion. So that could be eating into their free cash flow in the short term, even if it leads to, bigger profits down the road.
So it's kind of a trade-off.
Yeah, exactly. Investors need to weigh those short-term costs against the potential long-term benefits.
So are they essentially sacrificing short-term gains for long-term growth?
Potentially, yeah. That's the question investors need to grapple with.
Really interesting. Okay, so let's dig into that capital program a little bit more, because I'm really curious to see what they're spending all that money on.
Yeah, let's see where those billions are going. So they've got a bunch of different projects in the works. Network expansions, technology upgrades, new equipment purchases.
Okay, yeah, I saw that. It all seems pretty standard for a railroad, but is there like an overarching strategy here?
It seems like their main focus is on efficiency and reliability. They want to be able to move more freight with fewer delays and lower costs.
That makes sense. And from an investor's perspective, I guess that's a good thing.
Yeah, I mean, if they can execute on this plan, it should lead to higher profits and a better return for shareholders.
Hopefully. But, there are always risks, right? I mean, their documents mention things like competition and regulation.
Sure. Of course. Those are always going to be factors in an industry like this.
Yeah, for sure.
And they even talk about the risk of future pandemics, which, after what we've all been through in the past few years, That's definitely something to keep in mind.
Yeah, no kidding.
Uh,
So how well do you think they're prepared to handle these kinds of
well,
risks?
they talk a lot about investing in technology. Things like advanced train control systems,
Mm.
automated yard operations, predictive maintenance.
Okay, so they're trying to get smarter about how they run the railroad.
Exactly. And that's not just about cutting costs. It's also about making the network more resilient and adaptable.
Right, so if there's a disruption, they can bounce back more quickly.
Yeah, that's the idea.
Now, what about labor disruptions?
Ah, yeah, that's a good point.
I mean, they just signed a new agreement with Unifor,
They did.
but, labor relations can always be tricky.
Oh, absolutely. And those kinds of issues can really hurt a company's bottom line.
Yeah, for sure. So I guess investors need to keep an eye on that.
They do. Even with a new agreement in place, there's always the potential for future disputes.
Okay, fair enough. Now let's talk about their guidance. They're projecting low single-digit EPS growth for the rest of this year,
Yeah, I saw that.
which seems kind of conservative to me. I mean, given all the investments they're making and all the growth initiatives they're talking about.
It does seem a bit cautious. Maybe they're just trying to manage expectations.
Yeah, maybe.
Or maybe they're worried about the economy, you know?
Yeah, that could be it.
But then they turn around and project high single-digit EPS growth over the next 3 years.
So which is it?
Well, that's the million-dollar question, isn't it?
Yeah.
I think investors need to really scrutinize those projections.
What are they basing those numbers on?
Are they assuming a strong economic recovery, continued pricing power, successful execution of all those capital projects?
Yeah, lots of assumptions baked into those projections.
And projections are not guarantees.
That's for sure. So what are some red flags that investors should be watching out for?
Well, one thing that caught my eye was their debt levels. Their adjusted debt-to-adjusted EBITDA multiple has gone up.
Okay, and what does that mean in plain English?
It basically means they're using more debt to finance their operations.
Aye.
Now, some debt can be healthy for growth, but too much debt can be risky, especially if the economy takes a turn for the worse.
Yeah, you don't want to be over-leveraged when things start to go south.
Exactly.
So investors need to keep an eye on that.
They do. They need to make sure that CN's debt levels are sustainable.
Okay, good point.
Another thing to watch is competition. I mean, the transportation industry is really competitive these days, and there's always pressure to keep costs down and improve efficiency.
Yeah, for sure.
So investors need to make sure that CN is staying ahead of the curve and that they're not losing ground to their rivals.
Okay, so it's not just about looking at CN in isolation.
Right. You got to compare them to their peers.
So yeah, they stack up.
Right.
Now, before we wrap up, I wanted to ask about one more thing. They mentioned in their documents that they're looking at acquiring the Iowa Northern Railway Company.
Oh, yeah, that's interesting.
It seems like a pretty small deal,
It is relatively small.
but could it have bigger implications down the road?
Well, acquisitions can be a way for companies to expand their reach, get access to new markets, maybe even gain some competitive advantage.
I see.
So I think investors should definitely pay attention to this.
Even if it seems like a minor move right now.
Right. It could be a sign of things to come.
Interesting. Okay, so we've covered a lot of ground here. We've looked at CN's financials from all sorts of angles. But at the end of the day, what does it all mean for our listeners?
Well, that's the big question, isn't it?
It is.
And as always, the answer depends on your individual circumstances.
Your risk tolerance, your investment goals, all that stuff.
Exactly.
But I think we've highlighted some key things to think about.
We have.
So let's try to distill it down to some actionable takeaways for our listeners.
Okay, sounds good. So I think the first thing investors need to consider is CN's long-term strategy. They're making a big bet on continued economic growth and strong demand for freight transportation. But is that a safe bet given all the uncertainty in the world right now?
Yeah, I mean, are they being too optimistic?
That's the question. Investors need to decide for themselves if they buy into CN's rosy outlook.
Okay, so that's one thing to think about.
And then there's the competition. CN's not the only game in town.
Right, they got lots of rivals.
Yeah, and those rivals are constantly trying to steal market share and undercut prices.
It's a tough business.
It is. So investors need to ask themselves, can CN maintain its competitive edge?
Okay, so competition's another factor to consider.
And then, of course, there's always the risk of unexpected events.
Like what?
Well, we talked about pandemics.
Right, nobody saw that coming a few years ago.
Exactly. And there could be other things, too. Recessions, natural disasters, regulatory changes. You never know what's going to happen.
So it's all about managing risk.
Yeah, you got to factor that into your investment decisions.
And one final thought.
Yeah.
We talked about the new labor agreement with Unifor, which seems like a good thing for CN.
It does in the short term.
But Labor relations can always be tricky,
Oh, yeah, they can change on a dime.
so investors should keep an eye on that.
Make sure things stay smooth.
All right, so to sum it all up, CN has a lot of potential.
They do.
They're a well-run company with a solid track record,
And they're investing for the future,
but there are also some risks to consider.
like any investment.
Exactly. So before you put your money into CN, do your homework.
Read their financial statements.
Think about their long-term prospects.
And most importantly, decide if it's the right fit for your investment goals.
Great advice. Well, I think that's a good place to wrap things up.
I agree.
Thanks for joining me today for this deep dive into CN's financials.
My pleasure.
And to all our listeners out there, happy investing.